Hi there, happy Tuesday, and this is Ming Hon, your host for Traders Talk. All right, welcome for those who have joined us. We'll start off today with some market recap on what happened last week, and then basically also what we expect to happen this week, and then basically we will go for some trade digest today. And today we are going to actually do a trade digest on XLE, yeah, an ETF, and basically we will just show you some certain option strategy that you can actually use to actually trade on this counter or any counter which you like, yeah. But basically for today we're actually going to cover XLE, yeah. All right. Okay, so for those who have actually not joined our TikTok, please subscribe to our TikTok channel. I'll put it up here. This is our TikTok channel, and we post on and off some new contents on our channel, besides the Facebook and also the weekly Traders Talk. Yeah. Okay, let's just start off quickly today with the market recap of what happened last week, and basically what do we actually expect to happen this week. Let me just put on the screen. So far, the market has actually opened positive this week, and of course, let me see, the market has actually rallied over 2% yesterday itself. A great start to the week. All right. Okay. Hope you can actually see this. Okay. Good. So last week we actually ended up back to where we were the previous week, closing and the previous week closing. Yeah. So like we said that the market is actually holding quite strongly at the 3,600 level. This 3,600 level is actually holding quite strongly because last week we closed slightly below around there, 3,006. We actually went very much below after the CPI announcement on Thursday. On Thursday, we actually dropped all the way to about close to 3,491. Yeah, 3,491. We actually went to the lowest, and on the same day when we had this drop post CPI announcement, we actually had a rally up. We had a rally up on the same day. Which basically took back all the losses, temporary losses for maybe less than half an hour. If you look at the tip action last week, right? If you look at the action last week, what has actually happened last Thursday is actually quite odd, right? Quite odd. Let me show you where it was last Thursday. Last Thursday was somewhere. Maybe you can't see it here. Maybe here. Okay, this is here, I think. Thursday, yeah. So if you look at what happened Thursday, right? We actually closed here 3,576 on Wednesday. And then CPI was announced on Thursday, where the inflation was actually recorded at 8.2%, 8.2 instead of forecast 8.1, if not mistaken. Yeah. So inflation did not move down much. The previous inflation in August was actually 8.3%. Yeah. And then we actually dipped here about 3,577 all the way to 3,493. Yeah. So we did all the way down here, and only for a while. I think it is less than 15 minutes here. Then from there on, we actually had a rally up way above the closing on Wednesday. and way all the way up till here. Yeah, you can actually see we rallied. I think that day is actually almost about how many points from here to here is basically here to here is actually how much? Oops, okay, it's not working. Okay, we actually rallied about almost about from bottom to top is almost about 4.3%. Yeah, all in a single day. Okay, all in a single day. And of course, I mean, we would, I mean, nobody actually expected that to happen, but in fact it happened. I mean, that's the way the market is, right? I mean, when the panic actually started, where people actually sold, right, where people actually sold here, the market actually rallied all the way up here, but post that the rally was actually not was actually short-lived, and on Friday itself, we basically lost, I think, almost half of what the rally, half of it we actually lost on Friday. And of course, yesterday itself, again, we are up almost about 2%. We kept up on opening. And then basically we closed at 3677. Yeah, so quite volatile market. So so that's why for those who went short got killed, and of course the following day for those who actually went long, yeah, that means for those who went short on Thursday opening, or even before the CPI announcement, on anticipation that the market will go down, right, those people got killed. And then on Thursday, for those who actually bought the rally, got killed on Friday. And for those who have shorted the market on Friday, expecting it to actually continue to go down lower, actually got killed yesterday. So it is one day up, one day down. I mean, volatility again is a bit unpredictable for the market. Yeah. So where are we right now? Let's see. Okay, where are we right now? We are at 3677, and again, this 3006, which is also sitting on the 200 moving average, is holding so far. Yeah, it has actually held for 3 weeks, and now we are trying to actually rally up. I mean, for this week, basically, we do not see much major news coming through. The next I think, apart from Friday, where there is actually a Fed a speaker coming up on Friday. But apart from that, there is basically no major news this week. And of course, we would probably expect less volatility for the week. Hopefully, the current rally would actually continue to hold. And of course, this morning itself, the futures has also continued to go up. Let's see where the futures are up till now. Nasdaq is up 200 points, and S&P is actually up about 58 points. Yeah, so both is up so far. Still, indication is the rally might actually continue to actually go up, but the next major event would actually come on the 8th of November. 8th of November, which is basically the midterm elections for the US midterm elections. And post that, I think on the 13th of November, there is the next round of the Fed interest rate hike announcement. Yeah. So until then, I think the market, I mean, the expectation coming through to midterm elections, normally the market would actually rally, and especially we are also close to year end, right? So the probably the how to say, the major news which would basically crash the party would be the next forthcoming Fed rate hike. Yeah, because the problem with the inflation is not stamped, is not actually coming down. So of course, the targets for the Federal Reserve to actually bring down inflation to 2%, which basically is quite, I would say, impossible to run it down to 2%. And I do not know if the, how to say, their action to actually increase rates to which kind of level. I mean, so far it's only to 4.4% till year end. Yeah, till year end, and 4.6% beginning of next year. So this is what the Fed have said. But of course, the Fed always changes their mind based based on events. Yeah, and that's the scary thing for the market, right? And when they actually change their mind is no longer 4.4, maybe they actually want to run it higher, then of course that's where the market will again react to such kind of fresh news. Yeah. But in any case, because of the volatility, like I said, the how to say, the number of trades which we normally go out has also been reduced. So that is actually one thing which we have also how to say, we have actually also covered this way back beginning of the year, how to actually manage your account, what you actually need to do in a volatile market. We actually had a show way back early of the year. If you can actually check out our videos, we have one, let me just see if I can get it. We actually had one, let me see. We actually had one, I think, way back in the year. Maybe I search it for you guys, so it's actually easier for you to check. Way back in January or February, if not mistaken. Science. Okay, maybe I search it up and I will post it to the Facebook for your reference. Yeah, there is just so many videos that I have here. Okay, so I'll post it. I'll find it later and then I'll post it up. Which show we basically spoke about. Yeah. So S&P, yeah, we might continue to actually rally back because we are grossly oversold at the moment. We are grossly oversold. We might actually rally back all the way up till the midterm elections, 8th of November, and then that is the first major event coming after this, and of course the second one is 13th of November, which is the Fed rates, right? Fed rates. This is the elections, right? Elections, yeah. So these are the two. Hopefully, we can actually recover some grounds before the year actually closes. We can actually recover some ground here. Okay, but in the meantime, the market will actually continue to be volatile. So trade lightly, and of course, again, if you are in profit, yeah, take profits and re-establish your positions after you have actually taken profit. There's actually no real rush to actually get into trades aggressively, yeah, because like if you have actually come in situations like yesterday, one day up, one day down, then of course it is actually going to be quite difficult. And of course the thing which we'll cover today also will try to actually help you avoid this kind of volatility, so that the strategy which we will teach later on will actually be I would say kind of immune, or not that sensitive on the duration of the trade towards this kind of fluctuations. Yeah, so we'll actually cover that later using XLE as an example. Okay, so Nasdaq, of course, we we are actually about 34% down up to 36% down, in fact, from the highs up to last week. And of course, Nasdaq is a little worse, where it actually dipped below 200 moving average. And of course, yesterday itself, we had over 300 points rally, 300 points rally, coming back to again the 11,000 level. Yeah, for Nasdaq, I would say 11,000 level would actually be the so-called midpoint, in between point, where you see that over the past 3 weeks, it is basically crisscrossing back to the 11,000 points. Yeah. So of course, yesterday we closed at 11,062, and of course, with the current momentum, we might actually continue to rally up. We might actually continue to rally up, because we have actually lost quite a lot during this current wave down. So it's not surprising that we would actually recover some grounds back to the higher levels. Yeah. So that is actually for the Nasdaq. Yeah. Okay, so coming to our Trade Digest this week. So Trade Digest this week, if you have any questions, do post it on the chat, and I can actually cover it as and when we can actually go to a Q&A if there's any questions. Oops, let me just put it again. Okay. Yeah, it's up. Okay, so this okay, XLE. Okay, this is XLE. Can you guys see XLE? Okay, great. For those who have just joined us, we have just covered the market recap of last week. You can actually watch the reruns. So in fact, all these are actually recorded. You can actually go to the reruns to actually watch if you have actually missed the first part. Yeah. So today we're actually going to go through a trade example using XLE. Okay, if you guys do not know what's XLE, XLE is actually the ETF for the energy sector. So if you look at Yahoo, right, XLE, okay, you can actually see the components of XLE is actually let me see, profile. Okay, profile, is it in profile? The components of XLE is actually made out of all these companies: ExxonMobil, Chevron, Conoco, EOG, Schlumberger, Marathon, all Pioneer, Phillips, Kinder, and all this. Yeah, so these are actually the holdings, which are basically all the companies in the oil and gas industry. Yep, with Exxon and Chevron taking more than 40% of the holdings. Yeah. Okay, then the other thing is, of course, if you look where XLE is, before we actually go to the chart, we can actually also use Finviz, right? Finviz, to actually see where this XLE is to date. Basically, if you look at XLE, right, XLE is actually ETF, right? Exchange traded fund. You can actually go to exchange traded fund. You can actually put here, you have all the various timelines for its performance. Okay, so if you look at XLE, it's actually sitting down here. So far to date, basically XLE has actually gone up by 41% this year. Yeah, 41% this year, and its current price is 81.28. Yeah, so basically it has rallied more or less from the price of 40 over dollars all the way to 80 over dollars for the current year. So that's actually from the first from day one. I mean, basically from 1st of January up till now, which is basically slightly above 9 months. Yeah, so that's 1 year performance. Then if you look at the 3 months performance, right, XLE, you can actually see that it is still 12% up from the past 3 months to about $81. Yeah, and if you look at the 1 month performance, basically XLE is up by 3.62%. Yeah, so basically you can actually see that 1 year is 40%. 3 months is actually about 12%, and then 1 month performance is actually about 3%. And you look at 1 week performance is probably at 1.45%. Yeah. So basically, the price for XLE, I would say it is actually I would say it's actually on the high side, and it's basically hovering around 80 over dollars, because if you look at the 3 months price is $81. No, it's hovering around $81, 80 over dollars. You can actually see that the price actually was reached in February 22, right? February 22, no, here is currently here, $81. Yeah. So it actually reached this price somewhere in March 22. Basically, this was actually the event after the Ukraine war, right? Ukraine war actually started in February. So basically, because of the spike in the oil price, it actually moved even higher during this time. And of course, during that, again, it went all the way high of 91 before coming down to about 65, and now it's actually at about 81. So I would say it's actually currently trading sideways. Currently trading sideways between the topish of 93 and the low is actually about 69, about low of about 69. and of course, for me, the how to say, with the things more or less status quo right now, with regards to the war, then of course I would say the oil price would actually continue to be high. Yeah. So when oil is actually high, then of course I would say there would actually be some downside protection. That it would not actually come down suddenly. Back for an extended term. Yeah, basically, it would actually not suddenly do a change in direction. That means basically you can see XLE here is here, right? It's actually I don't look at the weekly, maybe I look at the daily chart. Yeah. So this is the daily chart, right? You can actually see, yeah, that 200 moving average is actually still sloping up, right? So basically, the direction for this would actually still be going up, and this 200 would not will not actually change direction quickly. Yeah. And of course, it can trade between, but it won't suddenly change direction. That prices suddenly change direction going down significantly. So I would say risk is more on the upside. Downside is moderate risk for this stock. Yeah. But because it's actually trading in range, then the strategy which we would actually want to use is actually going to be a neutral strategy. Okay, so when you expect the stock to trade in range, then that's where you actually use a strategy which is actually neutral, to allow the stocks to actually move beyond a range, a high range, and then basically a low range. Yeah, as long as the stock trades within this duration until the expiry or close to the expiry of your options contract, then basically you would actually be in profits. Yeah. So the strategy which we are basically going to use today is what we call an iron condor. Yeah. And of course, iron condor is a neutral strategy where you actually expect it to trade in range, and the risk profile would basically be something like this. Yeah, something like this, where in event you actually end up within the price of here and here, then you actually make the full profit. And of course, if you go outside the boundary here, then you would not make the full profit. And of course, if you go out of the boundary here, then you actually make a full loss on the trade. Okay, full loss on the trade. Okay, so then how to actually structure this iron condor is actually pretty simple. Let me just put up this to share with you guys. Share screen. How you do this is quite simple. Okay. Okay, so at least simple for me because I actually practically do this every day, right? Yeah, but for those who do not know, I will also teach you a very simple method. You do not need to actually think quite a lot. Like I said, it's actually a strategy where we actually trade range. Okay, and to actually structure out this strategy, right? You actually have two legs to the trade, and it's actually made out of two vertical spreads. Okay, like earlier you actually seen the chart, right, where there is actually an upper boundary and then a lower boundary. Okay, and basically we try to actually structure out a vertical on each of the boundary, and if you look at XLE, right, a few things which you actually need to know when you actually go into a trade like an iron condor is actually a credit trade. Credit trade means that you are actually taking a position of an option seller. Option seller means you actually collect the premium upfront. You collect the premium upfront, and your target is for this premium to actually run down to zero. That means the premium to actually run down to zero or close to zero, and you actually buy it back at a lower price than the price you actually sold it for. Yeah, so that is actually a what we call a credit trade. Okay, when you actually enter credit trade, you need to actually know a few things. One is actually the IV, the implied volatility of the stock or the counter you are trading. Okay, so implied volatility basically looks at how volatile the stock is, and of course the more volatile the stock is, the more premium you're actually going to get paid for the for selling these options on this stock. And you can actually look at this platform. This is actually the Tastyworks platform. You can actually look at the profile here. You can actually look on the profile here, XLE. You can actually see the IV here which is actually at 45%. 45% is actually considered very high IV, which is very suitable to actually sell premiums on options. Yeah, so 45 is actually a good indicator. First thing is to look at the IV, and of course the other indicator which book you can actually find on this Tastyworks platform is the IV rank. The IV rank, which is also very high, which is actually 73.5%, 73.5%, which is also quite high. Anything above 20 IV rank would 20 IV rank would be considered high up. So this IV rank is actually showing at 73, extremely rich premiums coming out from here. Okay, so that's the two indicator, IV rank, and of course liquidity is the next thing which you actually look at. You can actually see from this platform 4-star liquidity. Okay, 4-star liquidity, I think this is the highest liquidity. So that means this ETF is actually very liquid, 4-star. So for those options which we should see 2 stars, then of course don't trade on them, because the what is that? The spread will actually be quite high. The buy and sell spread will actually be quite high, and that would actually be not so good for you to actually enter and exit the trade. Yep. So 4-star liquidity is good. So 1, 2, 3 things we should actually look at that. Yeah, and of course just now you have actually seen already the stock chart, yeah. And then of course the highs and lows you can also see here. Volume for the day you can also look at this, yeah. But the most important is IV rank 4-star liquidity. Okay, all right. Then of course the next thing we should actually look at when entering a trade is the expiry dates. Okay, for more liquid expiry dates, go on the monthly expiry dates, and of course you can actually see on the platform quite easily which are the monthly are the ones which are actually more shaded here. You can actually see 21st October is the monthly, 18 November here is the monthly, 16 December is the monthly. You can see my mouse, right? I think you can see my mouse very small. Okay. So the shaded ones is actually the monthly, and of course besides that you can also look at the W here. W are actually the weekly one. So more liquid options actually sits on the monthly, so you actually try to go on monthly trades, yeah. Then of course the next thing is the duration. How long would you actually go about doing the trade? And of course for strategies like iron condor, basically, or any credit spreads, basically, we try to actually do between 30 to 45 days, 45 being the optimum. And of course, anything less than 30, try to actually avoid it. Yeah. And of course, because the current monthly expiry is actually sitting at 31 days, I we still can, and of course that would be compensated by the high IV. Otherwise, if the IV rank is not high, if you actually do a 31 day or 30 days credit spread, then the premiums might actually be lower. But for this, since the IV rank is high, hopefully we can still get a decent premium. Okay. Then of course the next thing which you guys see is actually the expected move. Okay, the expected move is actually showing on the right side of the options chain here. You can actually see 31 days expected move is actually showing at 784. You can actually see this, my mouse moving here, 784. And what is this expected move? Basically, it is actually what the market expect XLE to move up or down by 784 from now up till 31st. So for example, the current price is $82, right? $82. The market is expecting XLE to move 784 by 18th of November, means 82 plus 784, which is about 90, going to about $90. Plus 8, just round it up to 8. Though 82 plus 8 is 90. I hope my maths is okay because I failed maths, you see. So yeah, 80. Okay, and then of course, if going down, then that would be 782 minus 8. 82 minus 8, which will 82 minus 8, which will be 74, right? 74. Okay. Okay, so between 90 and 74 is the expected move. Okay, and again, to actually run down that, you can actually also see there is actually a gray line here. Okay, you can actually see from the options chain, there's also a gray line here. Okay, here. Then you can see this is not gray, not gray, brown line here. Okay, this brown line also indicates the expected move. So instead of looking here 784 and doing your calculations, you can also use the brown line to more or less indicate where is the expected move. Just now we are saying 74, right? And 74 and 92, right? So if you look at going to the bottom is 74. This is 74. Yeah. So this is 74. And then going to the top is 92, right? So 92 is here. Okay, so 92 is here, right? So 92. But of course, here the expected move is actually lower than 92, which is sorry, the here is actually lower than 92, which is actually coming to about 89, right? 89. Yeah. So you can still go to the expected move of 92. Yeah. Using here. Yeah. 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. No. 80. Yeah, it's 8. 1, 2, 3, 4, 5, 6, 7, 8. Yeah, so it's 8. 8 from. Oh, the last price is 82. 82. 82 plus 8 is 90. Sorry, 82 plus 8 is 90. Just now where did I think the price changed, right? I thought it was actually 80 just now. Okay. All right. So that's the indication. You can actually use this and this, or alternatively, I would also use delta 20 as a indication to actually do the upper and lower strike. Delta 20 upper and lower strike. Delta 20 is around here, 19 to 20. Yeah. So this is also an indication. Okay. So what we do for the trade is we actually do vertical, one on top, one on bottom, right? So when doing a vertical, it's quite simple. Sell one at delta 20 or the expected move, which here is actually 74, right? 74. Okay. And then you can actually do, depending on your risk, you can actually do $1 with, $2 with, $3 with, $4 with, $5 with. Yeah. And of course, the bigger the width, the higher the risk which you are actually taking, right? So normally when I do iron condor, I would just take a $5 with 74 and 74 and 87 here. Okay, 74 and 80, 7 here. Sorry, not 87, 74 and 69. Sorry, 74 and 69. This is actually $5 with, and for this you actually collect 80 cents. For this is you actually collect 80 cents, and this vertical is what we call a bull put spread. So this is actually on the lower side of the boundary, 74 being the short put, and then 69 being the long put, which basically kept your losses at 69. So for this you collect 80 cents. Okay, then of course on the other side we actually do the opposite, which is basically sell at delta 20 91. And then you can actually do 1, 2, 3, 4, 5 here, 96. Okay, for this you actually collect 58 cents. 58 cents. So 80 plus 58, 80 plus 58, 74 and 69, right? So you collect $1.38 for $1.38 for this trade. $1.38 for this trade. Okay. And I can actually also move this up to 90 to collect more premium, 153. And of course, on this side, I can also move this up if I want to. Okay, because I have some running trades here, right? I have some running trades, so I do not want to actually how to say, mix it with the current running trade. So I actually enter at a different strike price. Let's put 90 and 90, 95. And then here I put 70, 75, 1, 2, 3, and 70. Yeah, 75 and 70. Okay, so for this, I actually collect 171. Probability of profit 60%, 60%. Buying power effect is 329, which is basically $500, which is the width of the strikes, less of the premium which you're collecting, which is actually 171. Yeah, so that is how you actually get your max loss or your buying power, and this 171 is the credit you should receive. And of course, the probability of you getting half of the premium, which is basically about about 80 cents, right? 85 cents, right? Is 68%. There's actually an indicator here, P50, which shows here 68%. This P50 indicates the probability of you achieving 50% of the targeted profit is 68%. Yeah. And then the theta which you get is $3 every day. The theta, the theta which the premium decay will be $3 a day. So basically every day you collect $3 from this trade. So if everything is okay, you can actually put enter, send order. You can see again, check here, your credit receipt is 171, and then everything is okay, then you can actually send in your order. Yeah, so once the order is sent, you can actually put it, wait for it to how to say, to match lah. So again, the trade is let me see, 75.90, right? Okay, 75.90. So if you have any questions, let me know on the trade setup. 75.90. Okay, let's stop this and going back to the chart. 75.90. Okay, so this again, what will happen from now till November, right? November 18, right? This is 90. Okay, so you reset your upper and lower boundary, and then this is 75. Okay, so this is 75. 75 is here. Okay, so 75 and 90. So if you look at this, right, like I said, how to say, the current situation coming to November, the demand for oil is continuing to be high, right? Demand for oil is going to continue to be high, and of course, with that, the risk is, for me, is actually more on the upside. Although if you look at the current level where the price is actually sitting, right? So we have, of course, from the lows to the price where we are, we have actually this area where we are actually open to the risk, right? Where the price can actually come back to the lows, right? We have an area where we have this risk, and of course on the top side, the highest point is actually here, right? Highest point is actually here. And of course, the price can rally all the way, even higher than here, But of course, for oil, nobody likes expensive oil, right? Nobody likes expensive oil. So although it can be elevated, the time where it actually can hold elevated would not be long, lah. Because if it is too long, everybody will suffer, right? So of course, the chances of it going topish and coming down is actually also quite high. Yeah, quite high. So that is basically how I personally look at it. I mean, you may have other ideas, and of course that is also totally fine. But of course, I look at things more, how to say, more layman and more simple, how things can actually move. And of course, this kind of thing for me is even easier to actually so-called predict rather than going to see maybe whether Tesla will actually go up or go down in the next days after its announcement, or whether Microsoft can actually continue its rally of going up $4 or $5 every day. Yeah, that is even more difficult to actually predict. So I mean, things like commodities and all these kind of things basically based on certain fundamentals of the current economic, it can also be a bit more how to say, predictable. Of course, we can still be wrong, but of course the chances of it getting wrong, getting very wrong, maybe slimmer, unless major things like another war breaks out and all these kind of things, which can actually shoot all to even $120 or $130. That is a separate matter, right? But generally, I think this is how we can actually go. Okay, So again, okay, so that is actually on trade entry. Okay, so that is actually on trade entry. Of course, if you are actually afraid of the so-called upside risk, right? Upside risk, and you feel that all would actually continue to rally. In fact, you can actually how to say, you can actually structure out uh, a different kind of additional legs. I would say additional legs to be a bit directional on the trade also. To also protect maybe the upside risk, maybe to protect the upside risk. Okay, and of course for that you can actually do two bull put spreads. That means instead of standard iron condor you are doing, right, you actually do another bull put spread below. Okay, let me maybe I show you here. What I mean is this. Okay, coming back to the platform, right? Okay, so just now you actually entered this trade, right? Okay, you entered this trade. This is a standard iron condor with one bull put spread and one bear call spread, right? Okay, so you said, okay, I want to protect the upside more. I actually do another leg on this side. Let me see. Okay. Do another leg here. How can I change? Okay, never mind, I do it again. 75, right? 75. And 75 I do 2, and then 70 I do 2. Wait, no, 2. Okay, 75, 72, and then here I can do one, 90, right? 90. No, okay, you have to do it separately. Yeah, you have to do it separately. That means basically just now we have actually entered one trade, right? Iron condor. You just enter another trade of 75, 75, 70. You just enter another bull put spread. Okay, you just enter another bull put spread, and then you send the order. You send the order, and then if we analyze the trade, right? Analyze the trade. Here is my existing one trade. Let me see. Okay, actually you can analyze the current trade, which should be here. Analysis. Okay. Is this the trade? 70. So this is my existing one. Activity change. Okay, this is my existing trade. Okay, I have an existing trade running. I don't think I can analyze my trade here. Okay, you can analyze your trade if for the trade just now, right? Basically, what you will see is that you are a bit directional on the trade, but of course the risk would actually be higher. The risk would actually be higher, mainly double on the bottom. Basically, bottom you would have a risk of about $800 because you're collecting about, just now I saw about $98, right? $98 for the bull put spread. So basically your risk per trade there on that leg is about $400. Yeah. And of course, on the upside is actually again the difference, which is upside here 98 upside is you're collecting about 80 cents, right? 80 cents on the upside. So 80 cents on the upside, basically you're talking about 420 risk. So for the full trade, basically you're talking about a risk of 800 plus $420,200. $1,200. Is it so much? Sorry. Here is about 330, right? 330 plus another 400, which is $730. Yeah, 730. And the max profit you can actually get from this trade is 260. So 260 risk for 260 gains for 830 risk. Yeah, so 830 risk. So that's another alternative which you can actually structure out to how to say, to protect a bit risk on the upside. Like again, what I said is that the chances of it actually going high elevated for a long time is low. Although it can breach the top, right? Breach the top. It can actually come down, come back down to below 90 quickly. So of course, if you have a bullish trade on the bottom, you can actually make the profit first. And of course, if you are in loss on the bear call spread side, right? Then of course, you need to actually wait for it to actually come down to get back into profit on that leg. So it can be a neutral trade mixed with slight bullish, and also depending on time, you can actually control the trade. You can also exit at different time. Yeah, you can also exit at different time the legs. Yeah, the legs. Okay, so I hope that the trade is actually not too complicated. If you have actually understood the trade, give me a thumbs up so that I know you've actually understood. If you have not understood the trade, put in the questions you have or doubts you may have on the trade, so that I can also answer it here or even after the show. I can actually put it here. Yeah. All right. So that's the trade digest for XLE. Trade digest for XLE, and of course for me, this would actually be a safe trade. In fact, of course, for this XLE, I think for the past 1-2 months, I have entered into even more aggressive neutral strategies, which is doing strangles. I mean, instead of the bear call spreads and the bull put spreads, right? The vertical, right? Basically, I'm just selling the naked calls and naked puts, basically doing a strangle. But of course, I would not advise traders, not so experienced traders, to actually enter into naked positions like strangles, mainly because the risk can also be high. But of course, when doing it on ETF, that can actually lower the risk a bit. And of course, if this ETF is actually also related to oil and gas, right? Oil and gas, right? Then basically, the chances of it to sudden spike, unless major events like war and all this comes through, then of course the risk can actually be lower, and mainly the risk is always more prone to the high side, which is basically so-called unlimited risk. Yeah, if all shoots up to $1,000, right? Then that's going to be a problem if you're actually selling naked call. Yeah, but of course, chances of it going to if it goes to $1,000, then everybody would be in big problem, right? I mean, not only my position in the ETF. Yeah, so that's that's it. Of course, I mean, if you learn options, right, it can actually be quite interesting. It can actually be quite interesting because there is actually various way for you to actually structure trades. You can actually add legs, like what I have actually done from a neutral trade to actually omnidirectional trade, more towards skewed toward bullish, by actually just adding one leg at the bottom. And of course, you can also do it differently by adding some another additional leg on the top side, on the call spread side, or even you can actually do sell a naked put to actually make it even more directional. Even more directional. So a lot of things you can actually do with options, but once you actually learn the basics of it, and basically how each structure would actually behave, going through time, and also going through different volatility, then of course that would actually be quite useful for you guys in your trading journey. Okay, so I hope to actually see you again next week, and of course hope for the market to actually continue to rally, and all the best to you guys for the current trading week. Okay, catch up with you, and of course do like and share our channel. Do subscribe to our newsletter. Do tell more of your friends that we are always giving out such kind of goodies to you guys every day, to actually help you in your daily trading journey. Okay, all right, catch up. Bye bye.